Welcome to another episode of IBKR Podcast with me today, Head of Index Options Content at the Nasdaq in Chicago, Kevin Davitt. How are you, Kevin?
Andrew, I'm doing really well. What about yourself?
Doing very well for a very frosty morning here in Greenwich, Connecticut.
I'll hear none of it in Chicago, none of it.
We got another, they're not even calling it a nor'easter anymore. I guess it's coming from the opposite direction. It's a southwesterly.
You guys are going to have a 50-degree day before long, and I just don't have time for this.
Before we get another 17 inches of snow this weekend. So
okay, that I don't envy.
So, Kevin, we're back to record highs for several stock markets around the world. What's driving markets right now?
So I think that question could be answered kind of a handful of ways, which is a good thing. And the split sort of depends on your time horizon. I think if you took a broader based view, which I think makes a lot of sense when you're talking about all-time highs, I would argue that equity markets kind of continue to trend higher on the back of strong and growing earnings. We're going to get more insight with respect to that from some really influential mega cap names this afternoon, tomorrow, and next week. You continue to see on a global basis fairly accommodative liquidity or rate conditions. And I think you also continue to see reduced regulatory burdens and a resilient consumer. We have over the past couple of years focused a great deal of attention on inflation data. Now, despite that, the American consumer continues to spend. I think one of the points we'll talk about maybe later will be the labor market. I think that's super important. If I took a narrower view to this question with respect to time, and as the audience might know, I tend to see the world through the lens of the NASDAQ 100, I'd argue that the recent move has been driven largely by kind of hardware and semiconductor manufacturing names. The likes of Micron, AMD, AMAT, Lam Research, KLA-Tencor. We got a report from a European constituent in the NASDAQ 100, ASML, last night, did exceptionally well. Alphabet continues to lead this year after being a real major driver of index performance last year. I'd also highlight, again, coming back to that consumer portion, the resilience of the consumer with names like Costco up 12.5%, and Walmart, which was added to the NASDAQ 100 just this year, up 5%, and Amazon up 6%. So again, going a little bit back broad view, from my perspective, Walmart's recent inclusion in the NASDAQ 100, I think, is indicative of an evolution within the index and as an exchange operator. And that inclusion, where I believe right now it's a top 10 constituent, I think it's number 9 with like a 3% weight, reflects a diverse index that is growing in terms of constituency.
Very interesting. Let's move on to the next topic. I'm going to come back to the Magnificent Seven later. You referenced a lot of those names there. It's FOMC day. The Fed's going to make a decision on interest rates today. And by the time a lot of our listeners will have listened to today's podcasts, the Fed will probably have done nothing. Are we going to see further significant interest rate cuts this year, do you think?
Just to be clear, I'm somebody that thinks primarily through the lens of option markets. I'm not an economist. You often have Michael Knorr, my colleague on, or Phil McIntosh, and they think very much about those macro events. My tendency, again, through the derivatives lens is to look at something like the Fed Fund futures pricing. And what is that telling us right now? Because markets impressions are valuable. There is information there. And just to be clear for the audience, the Fed directly sets like very short-term lending rates. And despite cutting those short-term rates since, I believe, August of 2024, the 10-year yield over that same time frame has moved up from somewhere in the ballpark of 3.7% to like 4.25, 4.3. The market now, which can change, is pricing somewhere between 1 and 3 rate cuts, potentially by the end of the year. I should be more clear about that. 1 and 3, 25 basis point cuts. So let's call it 2, right? Could that happen by the end of the year? Yes, absolutely. The bigger question, I would argue, is about that inflation rate, which I referenced, and the labor markets. And I think there's significantly less clarity there, but that would be sort of where I would focus my attention as far as positioning and potential derivative, risk management tools.
I get the impression, and you mentioned something about the big names earlier on, that there's been a return of the Magnificent Seven. I think when we spoke a couple of weeks ago, we were both kind of somewhat impressed with the bifurcation in the technology rally. Do you think the Magnificent Seven's come back into vogue all of a sudden?
So I like the way you frame it. Maybe I'm skewed by my position, but I would kind of argue that the Mag 7 or Elite 8 or kind of whatever moniker you want to apply to it is factored into overall market outlook, no matter whether you're focused really exclusively on one of those names or not. The performance there is in some ways kind of table stakes. And going back to our point from a couple of weeks ago, I'm excited to see this kind of continued broadening of earnings growth. I mentioned some hardware names like those semi names that have become very strong performers that have gotten less attention in the 2 years prior. So this sort of broadening of the narrative beyond that real hyperscaler, AI-centric one, I think has led to a broader, more resilient market and sustained pushes toward, as we see today, new all-time highs. So I think the Mag 7, the Nasdaq 100 are kind of broadly at the epicenter of market influence these days, but the narrative is more inclusive, and that's something that I welcome.
What are some of the headlines in the tech space, Kevin, that you believe are helping spur higher highs?
So we're going to get a lot more clarity on this probably by the next time you and I speak, but the expectation and much of the rally over the past 2.5, 3 years has been led by earnings growth. We have not seen real PE appreciation over that time frame because earnings have been so strong and margins have been so strong. I think that continues to be the case with sort of potential risk speed bumps in the form of geopolitics or perhaps inflation rearing its head. And so while it might not be super actionable, the broad-based landscape, I think, remains the same. And that emphasis on real robust growth is the focus. And so long as that's the case, the backdrop seems fairly positive.
Kevin, you'll give us an update in a couple of weeks' time?
I would love to.
All right, brilliant. Thank you very much for joining me again today.
Thank you for having me.
And to the audience, thank you for listening. And remember, if you enjoyed today's episode, please subscribe wherever you download your podcast from. Bye for now.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice.